Greg, you want to take the table, please, and give us an overview of your finding? Do you have a PowerPoint or anything?
I do. It's right
Okay.
here. It's up right now.
Okay. And we have paper copies for those members that would like some up here. We have a box with some paper copies if you'd like. Theirs is in the folder. Okay. Greg, the floor is yours. And first of all, I'd like to thank you. I've watched your work as you go along, and I think you've done a great job of identifying how we tax oil and gas in this state. There may be some disagreement about where we go from here, but you put all the pieces in one box, if you will, and give us an easier way to look at it. So the floor is yours, sir.
Thanks, Senator Allen. So good morning. My name is Greg Upton. I'm Associate Research Professor at the LSU Center for Energy Studies. And as Senator Allen mentioned, I was asked to share with you the progress that we've made over the last 3 years studying mineral revenues in response to Act 4 of the 2018 second special session. So before digging into the recommendations, I'd like to first provide a very brief timeline of the work we've done to date, even that preceding Act 4. So in the summer of 2014, Dr. Jim Richardson approached me at LSU about participating in an overarching tax study that he and colleagues at Tulane, Dr. Steve Sheffrin, and Dr. Jim Alm were conducting via the request of the legislature. I was asked to focus on the mineral revenues piece of that work, which was later published as a chapter in this book right here, and we actually presented to this committee, I think, in 2015 or 16. Then, in the first special session of 2016, the legislature passed HCR 11, which created the Task Force on Structural Changes in Budget and Tax Policy. In January 2017, the task force produced its final report, and I'd like to read one key sentence from this report that I think describes the overall vision of tax policy in Louisiana and where we're trying to be moving towards. Quote, "The tax structure should be fair, simple, competitive with other states, and stable over time, short and long term. These qualities are best achieved with taxes that are broad-based with low rates and that do not play favorites for or against any particular constituency." So that's really the goal and the vision that we're working from, consistent with the task force recommendations. So then during the special session of 2018, SCR 4 was passed, becoming Act 4, requesting that we analyze the mineral tax laws in Louisiana and make specific recommendations. The resolution laid out a specific 3-year timeline for this process. So in the first year, we conducted dozens of meetings with stakeholders. This included industry associations, state government employees at both LDR and DNR and other agencies as well, academics who study tax policy, and dozens of people from private oil and gas companies. In February 2019, we released a status report that was provided to your committees, also made public on the LSU Center for Energy Studies website, presented to the Louisiana Tax Institute, the LSU Center for Energy Studies Advisory Council, among other groups. In the second year, we continued to receive feedback from these stakeholders and began working on collecting data and conducting analysis for the final report of recommendations. This report was released in March of 2020 and was again provided to your committees, published publicly on the internet, etc., and that's this report you have here. Our third and final deliverable requested by Act 4 is specific bills implementing these recommendations. So again, over this past year, we've had meetings with all these different agencies, stakeholder groups, etc., in order to make changes to revised statute 47633 that would implement these recommendations. These strike and edit changes were provided to the staff in November, and they've been provided to you today as well. So, what were the specific goals that we were requested by the resolution to balance? The first thing we looked at was to preserve and improve the competitiveness of the oil and gas extraction sector here in Louisiana. So this is not a tax increase bill. It's not meant to increase that tax burden. We want to preserve or improve that competitiveness. The second thing we were asked to do was decrease or remove the difference in the tax rate for oil and gas. And I want to read from you a document actually pulled up from our energy library at LSU this last week from 2002. And this was written by Mr. Bob Bauman, who many of you know today. Of course, he's a lobbyist here, and at the time was executive director of the Center for Energy Studies. And the reason I want to read this, it's going to provide some historical context, but also this is exactly true today. So Mr. Bauman states, the full severance tax rate on oil is 12.5%. This is the second highest rate in the U.S., and the effective rate is the highest. He then goes on to compare to Alaska, which is a bit of apples and oranges to the continental United States here. He goes on to state, the Louisiana severance tax rate on oil is approximately 3 times that on natural gas. Louisiana is the only state that has such a large difference in the severance tax on the two commodities. This is rooted in our history, and it's worthwhile to briefly review it. In the early 1970s, Governor Edwards doubled the oil severance tax rate to the current 12.5%. At that time, the price of oil was not market-based and was fixed, I believe at $3 per barrel. In doubling the severance tax, Edwards knew, which he only later revealed, that the United States was going to raise the fixed price by $1 per barrel. Thus, the oil companies would pay another 24 cents or so in higher taxes, but they would gross another $1 per barrel in revenue. The Edwardian logic being that both the state and the oil companies came out ahead. So the question for us as economists is there an economic reason in 2021 for the oil severance tax rate to be about 3 times that of natural gas? And in my opinion, the answer is no. There's no other states don't do it this way. There's no economic logic. This is the political history to how we got to where we are today. The third bullet point here is to create an equitable system of severance tax exemptions on all wells, not just horizontal wells. So as you know, the horizontal drilling exemption has been the largest exemption in the state. And so the question is can we sunset some of these exemptions, not just the horizontal drilling exemption, in order to bring that tax rate down? And then the fourth is to hold constant or increase mineral revenues for the state. So when we look at bullet point 1, verse 4, we take that to say that all recommendations that we're going to make are going to be what we call revenue neutral. So we're going to make recommendations that if they were enacted, you would bring in about the same amount of revenues in the future as you will if you don't enact these changes. And so it's not a tax increase or a tax decrease. It's meant to be revenue neutral. And finally, we were asked to explore other reasons oil and gas production is fluctuating and any changes that need to be made to increase production. So very quickly, and I'm not going to go through the whole 50-page analysis, of course, but this shows the severance, the tax burden on oil and gas across different states. And I'm showing 2 studies here. The first on the left was conducted by the late executive director of the Center for Energy Studies, Mr. Alan Pulsiver, as well as Mr. Bob Bauman, who I already referenced. And what they did is they looked at corporate income tax, sales tax, property tax, and severance tax. And when you took all of them into account, what you found is that Louisiana was sort of right in the middle of the pack there in terms of the overall tax burden. And if you ask Mr. Bauman today, he'll tell you the difference between Louisiana and Texas is well within the margin of error of the analysis. Fast forward almost 30 years here to 2018. This was another study that was conducted by a group called Resources for the Future in Washington, D.C., and they find a very similar thing, that Louisiana is right there in the middle of the pack, almost at the median in terms of the overall tax burden on this industry. But whenever you break it down further into oil versus natural gas, what you see is the tax burden, a larger share of that tax burden is on oil. And we're unique in this regard in Louisiana. Most states tax oil and gas at about the same rate. And so this is one of the big questions before us. So after looking at all the data, conducting the analysis, speaking with all these groups, we recommend the following. Number 1, to institute an equivalent volumetric tax rate for oil and natural gas with the rate to be established semi-annually. So that's a mouthful. Let's go through each piece of that. What does equivalent mean? Well, it means the same. So the tax rate on these two commodities can be approximately the same. Volumetric. What does the word volumetric mean? Well, we tax oil and gas actually on a different basis in Louisiana. Natural gas is taxed on what's called a volumetric basis, meaning that every MCF, which stands for 1,000 cubic feet, which is the unit of natural gas that's used in the marketplace, is taxed at the same volumetric rate. So what happens is once a year, the Department of Natural Resources, they do a calculation, they look at the market rates, and then they say, okay, this is the volumetric rate. Today it's something around 9 cents per MCF. And once a year, that's updated. So if I'm a natural gas producer and I sell my gas for a little bit more than the natural gas producer next to me, well, we're still going to pay that same volumetric rate for that gas. Oil is taxed on a value basis. So what does that mean? It is the value that the individual producer sells the oil for, less transportation costs in order to get that oil to market. So they take the value, and then they subtract out transportation costs, and then they pay the 12.5% on that difference. And so in practice, we just talked to a bunch of producers. And when you talk to natural gas producers and when you talk to the Department of Revenue, they seem to be pretty pleased with this volumetric basis. Yes, it's true that if you sell your gas for a little bit more or less, that's not taken into account, but they tell us that the simplification is well worth it. The oil producers, on the other hand, will tell you a very different story, and the same thing with the Department of Revenue. And so, we discuss in the report, but I'll point you to one court case, which is called Avanti versus Robinson, which is the oil company Avanti versus the state, Kimberly Robinson, Secretary of the Department of Revenue, that had all these disputes over this very issue of how do you calculate these transportation costs. And then to be established semi-annually, I think that rate can be updated twice a year instead of once a year to sort of more quickly take into account market conditions. Okay, number 2, remove exemptions associated with horizontal drilling, tertiary wells, and deep wells for new activity. And this is very important. If you are already in a play and you've made investments, we do not want to change the rules of the game after you've made investments. So for new activity, and new what we call regulatory units, these will be sunset. But for those currently using these exemptions, they will continue to be able to do so. And then number 3, to implement these recommendations simultaneously while maintaining this revenue neutrality. Our calculations show that you could get the severance tax rate down to 6%. Okay, think about that. Oil is currently 12.5%. You can get that down to 6%. If you do this in conjunction with these other changes. Now you have to sunset exemptions, and you're going to have to increase the severance tax rate on gas from 4% up to that 6%. And then number 4, to implement the new severance tax rates for oil and gas production from new activity. What does that mean? It means that if you have drilled a well and that well is currently producing, you will continue to pay the same severance tax rate you've been paying. So again, we don't want to change the rules of the game on people after they've made an economic decision, but for new wells drilled into the future, it would go into this new tax regime. So after making these recommendations, we received comments from both Lamoga and Loga, which are here today, and we've provided written responses to those comments, which were provided to you. But I want to highlight one overarching point that's been made repeatedly by stakeholders. And the comment goes like this. I'm sort of paraphrasing what people have told me. They say, Greg, if we were to create a severance tax system from scratch, the system you propose makes a lot of sense. But the political reality is that proposing a tax increase on anyone will make it difficult for an industry association to support the proposal, even if the result is broad-based, low-rate, and simple tax system aimed at bringing in the same amount of revenue for the state. And we have heard this repeatedly, and we wanted to address that very specifically in the reports. I want to read this one short excerpt. We say, any tax changes that are meant to be revenue neutral will by definition increase tax liability for some taxpayers and decrease tax liability for others. Therefore, a position that taxes must not increase for any taxpayer is inherently contradictory to the fundamental concept of broad-based, low-rate, and revenue-neutral tax reform. Tax reform that lowers taxes for some taxpayers and does not increase taxes for others will inherently reduce revenues for the state. In this specific context, leveling the rate for oil and natural gas will by definition increase the rate for natural gas and decrease the rate for oil. Producers that focus on oil will be impacted differently than those that focus on gas. And what I want to highlight is that this is a political consideration, not an economic consideration that we take into an account. So what is the desire of the legislature? If broad-based and low-rate tax reform is the goal, this is an inherent reality of achieving that goal. The goal of this report is to inform you of how these goals could be achieved if indeed that is your desire. And so that's where we sort of leave it off, where the economic analysis ends and that enters into the political sphere. So very quickly, 30,000-foot view of what we actually did in the statute. So we considered a hypothetical passage of this legislation in the summer of 2021, which is, of course, a fiscal session. If you were to delay 2 years, just everything would be pushed back 2 years. So we would recommend to enact the legislation on July 1st of 2022, meaning that you would enact the legislation 1 year post-passage, and you just write that into the last sentence of the bill. There's a way to do that. And the reason is because after speaking with Revenue and Natural Resources, they would want a year to sort of make these changes internally before the changes would be implemented. And the big change in the first year would be the move to the volumetric rate for oil. So again, it wouldn't really change for gas. The change would really be for oil and go into that volumetric rate. The new tax rates would begin and exemption sunset the following year. And so what does that mean? It means that if you're currently in the process of drilling a well and you've already leased this area and you've made these economic decisions to do this, we want to give you a little time to complete that project before those tax rates changes. For those reasons I was talking about earlier, you don't want to change the rules of the game after people have made investment decisions. The proposed reorganization, Section 4 is oil. So it's funny because it's a value basis now. We don't actually define what a barrel of oil is in the statutes. We had to add that. So we went to the Geological Survey and we got a definition of that. And then we made some adjustments to some of the exemptions for stripper and capable to take into account the tax change to make sure that their tax burden did not change. Section 5, distillate and condensate, is also taxed at the oil tax rate. And again, we provided a definition of that. Most of this from the current statute. Section 6 for natural gas, the big change here is that volumetric rate, which is actually a very sort of convoluted definition. If you look into Appendix A1 of the report, you'll find that the mathematical formula for how the calculation is done can be simplified drastically. If you were to read the statute, it would be very hard to understand how do you even do this calculation, so you can simplify that. So we've done that and actually moved it to a different section. And then the other change here is that on natural gas exclusions, we made some changes to vented and flared gas to be forward-looking and prevent some issues that are happening in Texas and North Dakota right now. Sort of a different issue we could discuss later if of interest. Then Section 7 is a whole new section. And this section would establish these volumetric rates. So we define what's called an oil price basis and a natural gas price basis, and we provide a very specific formula for how the calculations would be done. And DNR currently is the one that does these calculations, and then they send that rate to Revenue, which then publishes them and, of course, collects the money. We have worked with both secretaries on this formula, and so hopefully it's good to go, but, of course, we can make technical edits as needed. All wells with a completion date before June 30th, 2023, would have the current tax rate, which is 12.5% for oil, 4% for gas, and then all wells with a completion date after that date would then move to the new tax rate. So DNR would actually publish 4 rates now: oil for one's the tax change and post the tax change, and gas pre and post tax change. And then Section 7, publication of the rate, etc. Some cleanup clarification, but nothing big here. Section 8 is on the exemptions. And so we're going to remove inactive and orphan well exemption language. These were sunset previously, so we can just remove the language now. And we're also going to sunset the horizontal drilling exemption and the deep well exemption. How we sunset these, actually met with a company that is a big producer of natural gas, and we got with their legal team of how to get that language correct. And so we've done that, and of course also provided it to staff as well. Conclusions. So I've already said the major recommendations. I want to highlight one other thing in these alternative recommendations. Perhaps this is, too big of a change to make politically, and we completely understand that. There's also some sort of cleanup language and other smaller changes that could maybe improve the tax system as well. Number one, you could consider going to a volumetric rate for oil, even though the tax rate hasn't changed. So we have the structure to do that. The second thing is we should definitely remove, or in my opinion, you should remove the verbiage posted field price from revised statute 47633. And the reason for this is no longer an industry practice and has created some legal disagreements over how you do the valuation of oil. So just clarification within the statute with removing that language could be a useful thing to do. The third is to review and simplify the calculation for the volumetric rate for natural gas and establish that semi-annually instead of annually. So again, it's more cleanup language of making that definition more transparent and doing it twice a year instead of once a year. And talking with natural gas companies, of course I can't speak for all of them, they seem pretty open to this concept. It doesn't change fundamentally what's going on. And then finally, you could also remove exemptions and lower rates for oil and gas separately. So for instance, you could remove some of the exemptions for oil and reduce that severance tax rate for oil while not touching natural gas, for instance. And that would reduce the rate a little bit, but that's not going to get you anywhere near that 6% rate that we were just discussing. So thank you so much for your time. I'm happy to answer any questions, and we've got tons of analysis in the report that I've got behind this if y'all have questions about it as well.
Greg, thank you for your report. A couple of questions did come to mind. So the only exemption that's on the books that affects gas is the horizontal, correct?
No,
that
sir.
was done when it was a new technology. It no longer is a new technology, but they continue to enjoy that, and that hasn't been changed the time I've been here. But vertical gas doesn't enjoy the same exemption, correct?
That is correct. If you drill a gas well that's what we call a conventional vertical gas well, you will not receive the horizontal drilling exemption. You will only receive that exemption if it is a horizontal well. And according to numbers from the U.S. Energy Information Administration, 90% of the production from new wells over the last decade in the United States has been from these horizontal wells. And yes, that exemption was passed when it was a new technology trying to spur that new technology. Mm-hmm. Looking at other states, you do agree that the 12.5% on oil is high, second highest still, or the highest in the United States? It is the highest in the continental United States.
Okay.
Alaska has also a higher rate, but they also allow for subtraction out of transportation charges. And in Alaska, those are very large, as you can imagine.
Yeah.
Mm-hmm.
Yeah. All right. We're gonna kind of to keep this orderly. Are there any questions for Greg? I see Gary.
Thank you, Mr. Chairman. Good morning. Thank you for your work and your presentation. Just a quick question. Horizontal drilling, we passed that, as you said, to spur the activity when it was new to the industry and get them drilling here. Now, most drilling is horizontal for gas. Well, how do other states handle horizontal drilling as far as exemptions or credits or whatnot?
So some states do have exemptions for horizontal drilling for horizontal drilling. So I'll give you an example, like Texas, our neighbor. So they do have a horizontal drilling exemption for natural gas, but not for oil. And it's actually called the high cost well exemption. And so the level of the exemption that you get, there's a calculation in terms of if it's a high cost well, you get a larger exemption than if it's a low cost well. But keep in mind that Texas has a 7.5% tax rate on natural gas. So while they get that high cost well exemption, they also have a higher tax rate on that.
So what you're proposing would be to eliminate the credit altogether, though, and not go apples to apples with Texas on that aspect, just in an overall kind of comparison, getting us a little closer to that.
That's correct. So my opinion is if you were to enact these changes, the overall tax burden for natural gas would be very similar to that of Texas. But our system would be way more simple. So I actually talked to an accountant at one of the big accounting firms in Houston a handful of times when putting this together. And he said, you know, the way that we tax natural gas in Texas is a really good employer for accountants because it's very complicated. And so if you want a tax system that's a good employer for accountants, well, that wasn't our goal of putting these recommendations together.
In talking with the industry, because you did your research and you're looking at other states, I mean, do you feel like, or has it shown in your research that the exemption is driving current production or helping to spur that production on compared to other states and other activities? I mean, considering the fact that almost all new wells are going to use horizontal in some aspect, how is that going to affect the industry if we take away that credit to your model here?
Yeah, this is a very good question, and we address it specifically in the report. It is my opinion that the horizontal drilling exemption was not needed to spur the activity in the Haynesville Shale region. And the reason for that, you can look at a number of studies, and we do it in this report, where we calculate what's called the supply elasticity of oil and natural gas. We look at the relative sensitivity for the price that they receive. You can also look at other studies that look right at across the state line at differences in taxes. And what you actually find is that taxes are not the large driver of why people drill in one area relative to another. It's the geology, it's the access to markets, all these other different market conditions. And so it's my opinion that having a more simple, broad-based, low-rate system is gonna be just fine for having activity into the future.
All right, thank you.
Senator Luno.
Thank you, Mr. Chairman. Mr. Upton, currently what is our exemption for horizontal wells, gas wells?
It is 100% for 2 years or until well payout, whichever occurs first.
My understanding and what I've been told by numerous people is that the vast majority of the gas in the wells that we have here in Louisiana is extracted in the first 2 years. Is that accurate?
That is accurate. So wells have what's called a pretty fast decline curve. So at the very beginning of the well's life, it produces a lot, and then that declines pretty rapidly once production has begun.
All right, thank you.
Representative White, is that you? Who pressed over there? Oh, okay. Orgeron.
Yes, sir. Just looking for a correction there, Mr. Upton, if there is one, on the exemption phase out for horizontal wells in Section 8. There's a date that says all wells with a completion date on July 1st, 2030 or later will be ineligible. Is that a typo?
Oh, no, actually. So what we did is we sunset them. So how it's written in the language that we gave was until 2030, places that have these exemptions will have them. But at some point in the future, and we put it about 10 years out, they will actually be sunset.
All right.
Yeah, so no, that's not a typo.
Gotcha. It's for the existing ones, the ones that have the exemption or up until the date.
That's correct. So how we define it is for what's called a regulatory unit. So when you want to drill in an area, you go to the Department of Natural Resources and you go through what's called a unitization process. And so they establish a physical, what they call a unit. And all of the oil and natural gas that's produced on that unit is shared among the landowners that own land above that unit. And so how we wrote it into the statute was that units that currently have wells that are using those exemptions will be grandfathered to continue to use those. So new wells drilled in those units will be able to have that exemption until that sunset date, which we put out about 10 years, which is 2030.
Thank you.
Let's see. Senator Bernard.
Thank you, Mr. Chairman. I'm going to look Dr. Upton around. Representative Mincy here. I'm going to scoot to the right. No, I'm good. I'm good, buddy. I'm good. Thank you for coming today. And I was just curious. It's always curious when you do a report like this, you say, well, in case they don't approve or adopt this, I'm going to go with, alternatives. I was just curious, how big is the gap between the achievements of the major recommendations and the achievements of the alternative recommendations, in your opinion?
A very wide gap. One is fundamental change, and the other ones are, clean up language and those kind of things. Yeah.
Thank you. Thank you, Mr. Chairman.
Okay, sure. The board is clear. We're going to next. I'm going to go in order. Greg, I'd like to call you to the table for a couple of questions.
Yep.
If you don't mind, and then we're going to clear the table and ask both Aloga and Lamoga, which I see are represented here, to come present their opinions about the what's been presented here, to give everybody a equal shot. Greg, my question for you, and you're probably going to have several others, is you've obviously looked at the report somewhat,
right?
And maybe thought in the back of your mind, I'm not asking you to score it now, but are we close to revenue neutral?
As based on the report, and when the report was done, yes. I mean, it clearly intends revenue neutrality from the state fiscal perspective, right?
Correct.
Just to be clear, right? Different market conditions, different volume assumptions, projections, different price projections. Those are the kinds of things that have to be done today to make a projection of revenue neutrality, or just fiscal note projection in general. And I can work with Greg and DNR, and of course we'll be doing that anyway.
Right.
That might require some tweaking of the rate or the parameters of the bill. I haven't seen what he's actually proposing, other than just this morning, the actual markup of a piece of legislation. So I haven't looked at it, but as the report was generated, yeah, I thought it would be about as close to revenue neutral you're going to get
in this climate.
I mean, under those conditions and those projections. Of course, this is 2 years later. There'll be some different projections that'll have to be made.
Right. All right.
Let me add something too, because this is the first time I've heard the idea about the grandfathering in new wells on existing units with the exemptions. You're going to very likely load up a lot of wells in those units going forward. So that will affect, the realization of neutrality is going to be affected by that. Also, I'm not sure when you cut off dates, because typically, well, for example, when we sunsetted out the inactive well, or a previous program back in 2010, I believe, anything filed before June 30th was going to be in the program, and DNR got hit with 3,000 applications for this new program. So you think you're terminating it, and you are some years in the future beyond what you really think, because the behavioral effects, they will load it up. You can write language to address that, but if you don't, I mean, you're going to end up, I think, with a lot of wells in these grandfathered units, and you're going to end up with a lot of applications for exemption.
If we go out 10 years, because productive life of one of the wells is really only the 2 years up front.
Most of they get 24-month exemption for all practical purposes. Nobody gets payout on before the 24 months. Also, I do want to kind of address a little misperception. We passed horizontal drilling back in 1994. It was a package of 4 oil and gas breaks at the time. There wasn't horizontal drilling activity in Louisiana for 12, 13, 14 years. I don't know that we were really talking about horizontal drilling with hydraulic fracturing at the time, which did 10 years of work in the Barnett Shale in Texas before it ever moved over to Haynesville. And they didn't have any tax break for them. I mean, this was just a technology being developed and worked on by some wildcatters for a long time trying to figure out how to do this. Once they perfected that technology, and in fact, an industry guy told me at one time, tie together 3D seismic, directional drilling, and then the hydraulic fracturing. Put those 3 together, and that's what they were able to do, break these shales. We have a gigantic shale formation in the middle of the state, Tuscaloosa Marine Shale, and we haven't been able to crack it. There's been a horizontal drilling exemption. It's not about the exemption. It's about technology, geology, price, etc. So I really don't think we were trying to stimulate. We didn't know what horizontal fracturing was going to be in 1994. There was no idea.
So as far as development of revenues for the state, do you give any credit to the horizontal exemption?
Well, not much.
Okay.
We drilled a lot of these wells, though, and so once they reach their terminate their exemption, they're still releasing some volumes are coming out, and those have come online. I think it may have supported oil and gas or severance tax collections on gas eventually, but because we drilled several thousands of these wells. But generally speaking, I don't think it has much to do with their activity. And I'll point out another thing: when the volumes for horizontal Haynesville rocketed up, the volumes for vertical gas started to fall, and we shifted away from taxable gas into non-taxable gas. It actually cost us more than the foregone severance tax on the horizontal horizontal production from Haynesville, which we gave up through the exemption program. We gave up vertical gas production. It's permanently reduced, and the timing is just, I know correlation's not causation, but it probably is in this case. I mean, we incentivized a tax-exempt activity at the expense of a taxable activity.
Yeah. Now, once the 2-year exemption is up, 24-month exemption is up, we're taxing gas at what rate?
Whatever the current tax rate, 9 cents of MCF now, roughly. It's changed it's based on the value of gas in a prior, essentially the prior annual period for the beginning of the fiscal year. They set it at a volume, cents per MCF, but it is based on a price calculation from the prior year. So it's got a 1-year lag to the price of gas. Price of gas goes up prior year, severance tax rate's going to go up this year, and vice versa.
On a volumetric rate.
Right, yeah.
On a volumetric rate.
Right.
Okay. Question, Joe? Yeah.
Mr. Upton, I want to go back to one of the first things you said. You was talking about the goal that y'all were shooting for was fair, simple, stable, and to lessen volatility in the market. This is all the study revolving around severance taxes, but in reality, these tax structures and the studies that y'all done and conducted was only on oil and gas that's produced here in the state of Louisiana, correct?
That is correct.
So what you're trying to do is come up with some kind of way that that you can look for fairness in the system in regards to oil and gas produced here in the state of Louisiana.
Correct.
Okay, and so essentially it's almost kind of pitting oil industry versus the gas industry to kind of come up with some type of a neutrality way. But when it comes to the oil and gas produced here, so every barrel drilled of oil or gas that are produced in here, that tax is ultimately dealt with at, not only at the company level, but also shared in by the leaseholders who are property owners in the state of Louisiana, correct?
Absolutely.
So they pay their fair share of the severance tax. So this is a passed on. When you unitize the well and it's drilled in the unit, the leaseholders who are property owners here in the state of Louisiana, they're paying a portion of these severance taxes too, right?
It will depend on the lease that they agree upon with the producer, but the tax incidence or the tax burden, yes, will be shared by the producer and the landowner.
Okay, so under the severance tax model, we have companies who are Louisiana-based who are drilling wells here in the state. They're paying a portion of this tax. We have the property owners who are Louisiana citizens most of the time who own property here. They're paying a portion of this tax. So that kind of the whole structure of the severance tax. There's so much information that was coming out here that I'm just trying to piece together. So all of this is shared in kind by Louisiana property holders, Louisiana companies who are drilling, or foreign companies who are here drilling these wells. So when we start getting into it, I was looking at some of the numbers here. The severance tax revenue, and I'm going to point out to LOGA put in only 3 years of what the numbers were to the state of Louisiana based on severance taxes. So basically, they had severance tax produce $328 million in fiscal year 18, $285 million in fiscal year 19, $180 million in fiscal year 20. So that's just a 3-year snippet. But let's do a more historical thing, and you go back to, say, 70s and 80s. These numbers were in the billions, correct?
Correct. And if you can show a slide, I have it up right now with those numbers back to the 1960s.
So, okay, so I didn't see the slide, but as you go back further and further, we were talking about severance taxes being in the billions, not in the hundreds of millions. So what I'm looking at here is we're talking about fairness, but in reality, what we're talking about is sort of what I want to know is in the oil and gas industry, there has to be some kind of major seismic shift in the sort of the industry from the 70s where we were producing billions of dollars in severance taxes to now we're talking about hundreds of millions of dollars. I guess the question I got is we start getting in, if Louisiana people, citizens who own property are paying this tax, and Louisiana companies mostly sort of who are drilling here, they're supporting these things. Well, what is the foreign countries who sell their oil here, the hundreds of billions of barrels of oil that come in, what are they paying?
Okay, so that's yeah. So I guess that's gonna vastly depend on where the oil is coming from. So in the Middle
let's say
East,
if it's from Iran.
Yeah, so in the Middle East, those are Aramco is the national oil company, and they own the oil and they produce it. So getting a sort of apples to apples severance tax comparison, I don't have right here.
Do they pay anything? If someone from Iran sells oil here and it comes here, do they pay anything?
Do they pay like an import tariff?
Import tariff, processing tax, whatever. If it comes in through the Gulf, comes into the pipeline and comes up here to one of our refineries, do they pay any taxes?
My understanding is no, but Greg, you can...
Well, they're going to pay no severance tax to us.
Because it's not produced here on the severance.
No processing.
So there's no processing tax, but the severance tax side, so I'm looking at, when we start talking about fairness, how is it fair for Louisiana companies and Louisiana citizens and Louisiana property holders to share in these burdens of these taxes, but in Iran, Iraq, Saudi Arabia, regimes who basically sell their oil here and they pay nothing? I just think that as we're sitting there talking about the severance tax issues, I think the elephant in the room is not so much on pitting Louisiana companies in oil sector and Louisiana companies in the gas sector against each other to try to get them from a 12.5 top end tax to 6. Maybe tax everybody, the whole system, so that, because I'm looking at fairness and simple and stable and lessen volatility. But there's a serious issue going on if we had billions of dollars coming in at one time just 20, 30 years ago, and then now we got hundreds of millions. I think that the elephant in the room maybe is addressing all of that, because I'm looking at what your proposals is under these systems, and that's going to hurt Northwest Louisiana with the gas industry. I mean, there's right now currently they're the blown bright star in the oil and gas industry, and the severance taxes is the rigs that are running on the Haynesville. And I know that eventually at some point as the price of oil goes back up and may incentivize some things, but if you want to look at trying to get it down, I'm in favor of trying to remove the severance taxes down to the lowest mechanism possible in all industries. But I think that while you have one group not paying anything, and then you have industries here who are sort of the backbone of our state for 30, 40 years, they're getting crippled. So there's some issues that are going on here, and I don't know if as we look on this committee, as we start talking about these issues, I don't know if the fairness of it is to say, well, let's address the severance tax issue and only on the severance tax when it's Louisiana companies and Louisiana citizens that are bearing the burden of this, and then you got a whole huge sector that's not paying anything. And I would suffice to say that when you start looking at the billions of dollars that the severance tax used to give, it's because we don't refine domestic oil anymore. We're purchasing most of the oil on the foreign market that comes here. So ultimately, at some point, what we do produce will what we do produce here is not keeping up with the times, I guess, as far as the money coming in on the severance tax. There are ways that we can do this, but I think that if we're going to, all of us in this committee, as we start talking about just looking at one sector, well, then we're missing the focus on the bigger industry. We had testimony last year in the Ways and Means from a Louisiana-based oil company who drilled one well in Vermilion Parish, and he said 84 companies, his drilling one well down in Vermilion Parish supported 84 companies that are here. When we look at this is a big wall of this. We're being asked to tackle a historically difficult process, and even by your own testimony said it might not have the political will to get into this. If we're going to tackle some elephant like that, we need to start biting all the elephant, I guess, is what I'm saying. So it's just difficult because I know that the oil and gas people, the oil people in Northwest Louisiana, this is going to hurt. I did a lot of oil and gas work up there as an attorney, and I know what it's capable of. I mean, you ask people in DeSoto Parish and Caddo and Red River and what the Haynesville Shale has done for that portion of the state since 07 and 08. And not just individuals and companies, but you're talking about landowners, all of the people who own property there that got these leases. I mean, they had some leases that was up for $32,000 an acre. They had some of those leases in that area that was significant, and they have boomed. And right now, after what has transpired in 2020, not just with COVID, but airline industries and slowdowns with oil and gas, and then the price wars between Russia and OPEC plus. I mean, Northwest Louisiana right now, the whole state of Louisiana is dependent on our Haynesville Shale right now with the drilling there. And I know that what they've done in that area has only scratched the surface of what that play really could be. We have, and they're going to tell you, I'm sure, the increased costs with the gathering and transportation, but we have the infrastructure in place. We have the markets. We have the area. We have the gas. I mean, we have all kind of stuff there that could really boom this project going there. But to me, when you start talking about fairness, I don't see that it's fair that Iran can sell their oil here and process it here and do it for free, and we put the burden of back of these taxes on people in Mendon and Natchitoches and everywhere, and Vermilion and everywhere else that we drill in the wells. I think that may be the real elephant in the room that we need to be talking about.
Yes, sir. And you can simplify the tax system and reduce revenues. We could definitely show you how you would do that and calculate what that is. But the specific resolution asked us to present recommendations that were revenue neutral. And so that would be a question for you. And if you're interested in, hey, I would like to have some of these simplifications and reduce that rate for oil, we can calculate for you how much revenue loss there would likely be, and then that could be put into that process.
Representative Lacombe, I'd like to address some of the things you said. I've been doing oil and gas leasing in South Louisiana for 30 years. And I don't pay any of the severance tax. I know they have exemptions up there, but maybe my attorneys are better than the attorneys up there, but I don't pay anything. I get a net at severance as produced. So I'm not paying any of the severance tax on anything produced. I'm not saying there are some leases, but even the standard bath form gives the landowner a percentage of the revenue. Now it decreases the net revenue interest that the producer gets, but he's making his financial decision on that. To address there's many reasons for the volume and the amount of money being made by the state over years to now that's completely different environment. But to address the imported oil, as of last year or year before, the Superport loop became a net exporter of oil. We're producing more oil here than we're bringing in. So trying to go back and do some processing tax, I'm sure Lamoga would have a lot to say about a processing tax, as was set forth by Foster Campbell in the past. I would not be for that. You would shut down a lot of the industry in this state and run it to other states. So I don't think that's a solution either. But to address the fairness, Maybe that argument could have been made in the past, but we are now a net exporter of oil and gas in the state of Louisiana. So most of the volume comes from within the United States, and I don't think you can tax oil coming from other states because that's against the Constitution also. So that being said, I think that would take a good bit of wind out of a lot of your arguments. But listen, this whole dance that we're doing right now was spurred and because we needed to compare apples to apples, and it was spurred by industry saying 12.5% is too much on oil. And I agree with them. But how do we do it? Anything that we could do a partial revenue, Greg will be happy to score for you. But the last one that came to us last year had a $150 million fiscal note.
That would have been multiple years.
Yeah,
Cumulative.
but it had a significant fiscal note and a hit to the state FIS. And I'll ask the Jay Luno question: how are we going to pay for it? So anyway, just some comments as you were making your comments. So, would you like to retort anything I said?
No, I'm sure we can talk about it a lot.
Okay. Ogeron, are you? Is that your? No. Okay. Jay.
Thank you, Mr. Chairman. I think you actually asked the questions I was going to ask or clarify that landowners don't pay severance tax as a general rule. And Louisiana citizens do if they're a producer, a driller, but if they're an out-of-state driller, they're not a Louisiana citizen, and they don't. And so we aren't taking it from them. But I always understand the fairness arguments, and you know, as long as we're fair, and if we lose revenue pursuant to one of these proposals, as Senator Eiland, Senator Luno points out, and I have as well, what are we going to cut? And if we're not going to cut, where are we going to get the money from? Are we going to shift the tax burden to ordinary citizens to pay for this? So anyway, so you said it all, but I had my button punched, so I felt like being a politician I need to talk to.
And I always appreciate recognizing you, Jay.
Thank you, Senator.
The board is clear. Any other questions by any of the members?